Today, we're all doing our best to respond to best to respond to unprecedented changes, to keep our operations running, to support employees, to take advantage of the latest laws. CLA Intuition 2.0 shows the way forward with real-time scenario modeling. Change your decision points and see the impact on your future. No matter what tomorrow holds, you have a plan.
Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We hope you had a wonderful Labor Day, and we sincerely hope that you're continuing to stay safe and healthy at this time. Today, we're going to talk about payroll tax deferral guidance that was dropped prior to the Labor Day holiday, as well as relevant PPP updates, which, as you know, continue to evolve, and we continue to learn more every day. So I would like to welcome our guests today. We have Scott Hess with our BizOps office. He leads our outsourced payroll practice and has joined us for several of our live streams on updates related to payroll tax credits and deferrals. So welcome, Scott.
Thanks, Leslie.
He will cover some of our most recent questions and guidance with respect to the payroll tax deferral. And then I would also like to welcome Rick Kruger. Rick is with our National Assurance Group, and he and Jack Rybicki, who many of you know, will be covering our latest and greatest on the PPP updates. So welcome to the three of you.
Thanks, Leslie.
We appreciate all of your questions and interaction that have come through our inbox at Livestream at claconnect.com. They are awesome. We love having you guys be part of the conversation with us, and we're monitoring and responding to them daily. We encourage you to continue submitting those, because today we are devoting a significant part of our session to addressing as many of those as we can while we are live with you today. We also would like to remind you to visit our COVID-19 landing page at claconnect.com, where you can get a lot of up-to-date information about tools, programs, and other ways to connect with us on any other specific needs or consultation that you might have. So with that, I would like to start with Scott today. And Scott, we have had just a flurry of activity since Trump issued what we'd like to call really more of an executive action. It was back in August that was really set to take place September 1st. And we didn't have much time between the September 1st start date and when we got guidance that we were all really anticipating, which happened late on Friday, August 28th. So not only was that guidance late, but when we got it, it was a scant 3 pages. So a little bit left to be desired. But what were some of the highlights that you can tell us about that guidance?
Yeah, you're right there. Pretty scant is the key word. I think it was barely 2.5 pages, double spaced, and so in its brevity, I think it failed to address a number of issues that people are interested in getting answers to, like number one, whether the deferral is mandatory or not. So right now, that's kind of the question we're getting most often, is whether I even have to implement this deferral. And so the notice, what it does contain is it does give the employers the ability to defer withholding and deposit of the employee's Social Security taxes without penalty. But if you read in there, there really is no mechanism that forces an employer to do it, or any penalties that are incurred if an organization chooses to continue to withhold and just pay the tax. And in fact, Mnuchin, shortly after the presidential memorandum came out, said in an interview that this was really going to be voluntary and up to employers, but that was not explicitly written into the notice. Mm-hmm. So what we do know in there is that if the employer does decide to move ahead with the deferral, that they're ultimately responsible for the payment of the tax, and what they're directed to do is withhold that deferred tax ratably from January 1 to April 30th of next year. But unfortunately, the notice doesn't really address, what happens in the situation that an employee goes on unpaid leave, if they quit, or if they're terminated before the end of that repayment period. So, it seems to infer that, perhaps an employer would have to just deduct that balance from the employee's last paycheck, or try to come up with some other arrangement with that employee, but it really leaves that up in the air. And what we do know is that no matter what, the employer is on the hook for that money. So they've got to pay by May 1st, whether they collect from the employee or not.
Yeah, so that definitely puts a ton of onus on the employer, I think. And maybe we can also talk about what wages exactly qualify for the deferral, because we did get a little bit of guidance with respect to that in this notice.
Yeah. The notice sets the threshold for the applicable wages at $4,000 in a biweekly period. So that's if somebody's under that, they're eligible for the deferral. If they're over, they're not eligible, and that's going to be determined on a period by period basis. So you could have an employee that's eligible one pay period, but not eligible the next. So it's really going to be confusing for employees to, perhaps see that on one paycheck, but just to have it go away on the next. And the other really key in there is that it does appear to be a cliff. So if you make, $4,001 in a biweekly pay period, you're not going to be eligible for the deferral, and you're going to have the full amount withheld from your check as normal.
Yeah, so that even creates a lot of confusion and volatility just based on possibly how the wages are hitting your paycheck. So we've talked a little bit about some of the risk for employers, maybe because an employee leaves. We've talked about the wages and cliffs based on the threshold of the wages. Can you summarize what are the pros and cons, so as companies are sitting here, they can maybe consider what they should think about as they're thinking through this program?
Well, we know there's one advantage. The employees are going to get a short-term boost in their pay out of this, but they really have to understand that as of right now, that amount needs to be repaid. So it's really just an interest-free loan, and it's going to place a greater burden on them in the following year when employers have to double up on that Social Security amount. So, kind of on the disadvantages, the challenges really come in all the administration of this. I mean, employer really has to answer up front, am I going to offer the deferral? If I am I going to give my employees the option to defer or not? So am I going to make it mandatory or let them opt in or out? Is my payroll system ready? I mean, we're hearing still from a lot of software companies that they're not ready. They may not be ready till closer to the end of September. And so that plays a part in it as well. And then the biggest one really, am I prepared to foot the bill if an employee leaves early prior to the end of that repayment period? So, we're hearing from a number of organizations, like the U.S. Chamber of Commerce is saying that many of its members aren't going to go ahead and implement the deferral. So right now, just a lot of confusion, people still waiting for some more guidance. We don't know if there's any more coming. There's been some pretty detailed FAQs on some of the other payroll provisions that have come through. And, still, I think many people are waiting to see if there's going to be any sort of legislative support to make this thing permanent, as the president suggests, but doesn't seem to be a lot of momentum right now in that direction.
Well, this was a really impactful update, and we are going to keep you around as we get questions throughout the session today and bring you back at the end for some of those. I'm glad that you brought up the legislative update. I'd like to pivot over to Jack and Rick. And Jack, I'm going to start with you and just talk for just a moment on the legislative update and how it impacts the PPP. So really just a couple hours ago, we saw that the U.S. Senate Republican COVID-19 proposal did not have enough support to go through for a vote. And the key that we need to keep in mind here is that at this point, we really only have proposals from each side, and we've got negotiations taking place, between both parties. But if you look at the size of the bill that was considered today and you compare that to what was proposed by House Democrats, it's pretty clear that they're still pretty far apart. And our source in Washington is telling us that the Speaker and the House have shifted their attention to passing a bill to fund the government and prevent a shutdown. So it doesn't sound like they're much closer to a deal than they were a few weeks ago. I mean, we all really kind of thought that in August, perhaps we were going to get a second round of relief and legislation. There are still a few weeks left in this month before all those lawmakers are going to leave and go on the campaign trail. So maybe there's a possibility out there for action and the short window to bridge the gap. But when we think about this and we think about, I think, some of the hope that people had with a second round of a bill for the PPP, there were a couple impacts that we were thinking about. Now that we've got a stalemate with those, I'm curious, what are a couple of the areas that are being impacted by the fact that we've had no movement in legislation?
Yeah. So, I mean, the bid ask, unfortunately, is very wide right now. And now you've got three parties involved as well, right? You've got for a while, it was just the House, which had, passed the HEROES Act, and you had Mnuchin negotiating on behalf of the White House, right? And there they were actually starting to narrow the gap, right? The House had come down to, 2 point some odd trillion dollars, and the White House had moved up to $1.5 trillion. So they were closing the gap. What McConnell and the Senate Republicans threw out was really a net $300 billion bill, right? So just now really blew that gap wide open. I guess the positives you can take from this are that there is some consistency in the proposals we are seeing between all three of those groups, though. And so while we don't know timing of when something is going to happen, when something does happen, and it will happen at some point, it is likely that there will be something favorable with respect to the PPP, right? So there was, in all the proposals, there is a provision for the blanket $150,000 forgiveness. There's likely going to be some type of certification required, but it's not going to be a labor-intensive certification process where you have to report a bunch of financial information. It'll be really more one that if there is fraud abuse, you can still be prosecuted if you fraudulently use the funds for inappropriate purposes. So more of a, I use the money like I said I was going to, rather than reporting all of it. We also have seen that there's clearly support for an additional round of PPP funding, particularly for those businesses that are still experiencing significant declines in revenue. And so the Republican bill that was proposed had a revenue threshold. Originally it was 50%, then it was, I think, 35 or 30% reduction in revenues that you had to have in order to be able to apply effectively for another round of PPP funding. That second round would be capped at $2 million, and it would only be available for companies with 300 employees or less. So again, kind of shrinking the pond, trying to work with smaller businesses that were, dramatically impacted by the COVID, pandemic. Again, if something does pass from a COVID relief perspective, we would envision both of those things to be part of it, because those two don't, have a lot of controversy associated with them. There's bipartisan support, House and Senate, for those. It's everything else that they're arguing about. So, that's the bad part is, a lot of our borrowers that were in that under $150,000 bucket, we've been telling, hold off, don't worry about it, because you're going to be able to sign a form and be done with it. And the banks have also been telling their borrowers that. And so right now, if people want to get these loans off their balance sheets and get forgiveness, there is a chance that those folks might need to incur the additional costs in order to, put in the application, aggregate the data. You could likely use the EZ form, or hopefully they would be able to use the EZ form. But even there, you're still going to take time. There's opportunity costs involved. And so, it is a shame that we haven't been able to have at least that pushed through on some bipartisan basis. So.
Well, thanks for that summary. And I'm really glad that you talked a little bit about just the process of forgiveness, because I want to ask Rick now, as we get close to Q4 and we start to get people's heads around year end and financial statements, how people should start to deal with their loans, particularly if they aren't forgiven yet. I had a client tell me today that they have submitted their application, put it in front of their bank, and they have 30,000 other loan applications in front of them for forgiveness. So even if some people want forgiveness before the end of the year, it may not happen. And so that's one question, is how should people be accounting for and treating these as they're either, in the process of getting it forgiven, but it's not forgiven yet. And then also some people are asking, what is the geography that it should sit on my financial statements when it is forgiven? So should that forgiveness income be included in my EBITDA?
Yeah, those are great questions, Leslie. And there really are two paths that you can take when it comes to financial reporting. The simple path, and this is the one that I personally like the best, is treating PPP as debt until you're formally released from the PPP loan. It makes sense to me. It's consistent with the legal treatment, and it's much simpler than the alternative. So with that option, legally it stays a loan from the bank until the SBA approves and funds forgiveness. And at that point in time, that's when you'd record a gain from an extinguishment. Now, there also is a more complicated path that the standard setters left open, and it really wouldn't be PPP if there weren't a more complicated option for us to sort through here. And it does include a few options, actually, but I'm just going to talk about the most common of those options that people are using here in practicality. And that option is treating PPP loan as a grant. And that's actually available both for-profit and not-for-profit entities. Normally, that only would be open for not-for-profit, but FASB was specific that for-profits can use this option as well if they meet certain criteria. Now, under the grant option, you record PPP as a refundable advance liability, so it starts in the same place on your balance sheet, more or less, and then you take it into income at the point in time when you meet the barriers to forgiveness. The reason it's complicated, though, is that standard setters have been pretty silent as to what those barriers specifically are. And so there's a lot of room for debate yet on the timing of when you record income if you go down that option. For example, this is just one of many potential barriers. But for example, it's pretty clear that spending the funds would be a barrier to forgiveness. It's much less cut and dry if the forgiveness application itself would be considered a barrier, and if that would be relevant in terms of when you actually record income. Ultimately, we're finding as we're working with clients, as they're going through different fiscal reporting seasons right now, it really does come down to facts and circumstances. But again, that's why I do like the simpler path. Is it's more consistent with the legal treatment of the loan, and also just a lot easier for everybody to apply here. We do have an article on our website to try to sort through some of that, but like I said, there's lots of different options laid out there. So please do just give anyone at CLA a call or email us, and we can certainly talk you through that. As far as your EBITDA question, Leslie, and where it falls on the income statement, we definitely get lots of questions about that. As well as PPP forgiveness's impacts on other metrics or ratios, such as a debt service coverage ratio. And to give a little bit of context, for most of the organizations that I work with, the reason why they're asking those types of questions is compliance with their other debt agreements besides PPP and trying to figure out the impact that forgiveness will have on their compliance. Now, the tricky part with answering that question is we know the answer, give or take from a financial accounting standpoint. But if you're thinking, am I in compliance with my debt agreement? Each debt agreement can read differently from one another. So it's really important that you follow the details within that specific agreement. We're finding in practice here that this can go one way or the other, depending on how they treat certain types of income and other one-time items. Furthermore, a lot of covenants are not necessarily written based on financial accounting. But if you legally have a loan, even if you recognize the income for GAAP, you still may legally have a loan obligation with a bank, which can trigger some covenant violations. So lots of different things to consider. Definitely need to pay attention to your debt agreements themselves if that's your primary consideration when you're thinking about that.
Awesome. Well, thanks for that, Rick. And now I'd like to stick with timing considerations for just a second. So the financial statement impact was a good one. And Jack, I don't know if you know this, but there's a big tax deadline coming up next week. I've personally been buried in it. And we have had a lot of conversations with clients on just modeling what their projections are looking like for 2020. Certainly, without getting this bill passed, we've had a lot of confusion over, if the PPP is forgiven this year, how do we adjust for the expenses or not? And so, what I would love some commentary on is as people are getting into preparing projections and really doing year-end planning, what are some things that they should consider related to estimating their taxes? And is there also any strategy to potentially pushing back that forgiveness into 2021? So what are some good talking points that you guys are seeing?
Yeah, and so great questions, and particularly a really relevant topic for this time of year for a lot of our clients that make estimated tax payments, right? And there is an interplay to what Rick just went over with us as well, because there's a question about if tax will ultimately follow GAAP in something like this. So if you take the GAAP treatment and treat it as a grant and then recognize it earlier than the actual forgiveness date, the question would be, what is tax going to do? Are those expenses going to be disallowed in that period because of the revenue treatment on the GAAP side? We don't know the answer to that yet. Ideally, again, go back to legislation. The legislative folks would take care of this for us by just coming over the top of the IRS and saying these expenses are deductible. Absent that, and I think there's probably a pretty good likelihood that we're not going to get that in the near term. It's not even in any of the bills that are currently being discussed, unfortunately. So let's assume that we're not going to get that help from our legislators. In that case, you mentioned a great planning opportunity. This may drive the GAAP treatment as well, in that if you don't ask for or receive forgiveness in 2020, then in theory, you don't know what expenses yet are going to get paid for or will have been paid for by a forgiven loan. And therefore, those expenses will be deductible on your 2020 tax return, right? Now, chances are, once you get forgiveness kind of adjudicated then in 2021, we would then know what those expenses would be, and you would have an add back in 2021. So you're going to pay the piper at some point in time, absent a legislative change, but you do get the time value of that money, right? So, if you have $1 million loan and you're going to get, $1 million of expenses reduced, that's, a $400,000 tax liability that you can shift back a year, right? So there's definitely some value in potentially planning around that, and that will affect distributions and other things. I know a lot of clients are really concerned right now about even making tax distributions before the PPP loan is forgiven, because there's a concern that the SBA would look at distributions saying, well, if you can make distributions, then obviously you weren't in economic stress, and therefore you shouldn't be asking for forgiveness. And so there's a lot that gets wrapped into this, but a planning tip that we are definitely telling our clients to consider is wait to recognize the revenue into 2021, and therefore take the tax deduction in 2020. But plan for it and make sure you understand you will have a cash burden in 2021.
Awesome. All right. Well, now we're going to go to a couple of the questions that we've gotten from the live stream inbox. And so Sherry asked the question that if it takes 90 days to get a loan forgiven after they submit it, and there's a 6-month no payment period that will be up before forgiveness, how are they to treat that? Can they simply do a change in terms and extend the date that the first payment is due? So Rick, I'd love your insight on that question.
Yeah, great question, Leslie. We get similar ones like this all the time because there is some confusion with the language of some of the earlier loans from PPP. So as quick background, the original loan terms, the original deferral term on loans was the 6-month no payment period. PPP Flexibility Act signed on June 5th extended that deferral time period, and it extended it retroactively for all loans. So there are some loans with the original deferral language of 6 months in the loan agreement, but really the PPP Flexibility Act overrides that. The language in those loans should also read something to the effect that if it conflicts with law would trump the loan agreement itself. And so the updated deferral period is, if you do apply for forgiveness, it would be the date that SBA funds forgiveness or informs the bank that they're not going to fund forgiveness is when you would need to start making principal and interest on any remaining unforgiven amount. And if you don't apply for forgiveness within 10 months after the end of the covered period, which is a fairly long time period, principal and interest payments would start at that point. It would start being amortized. But the 6 months, that really isn't something we need to worry about at this point.
Awesome. Thank you for that. All right, Jack, this next one is for you. So we've got Brenda, and she's asking the question if she's going to be able to certify under criteria 2 on her PPP-EZ. And so the scenario is that she's had an employee resign on March 27th of 2020, and she did hire someone to replace him in the middle of September. But the hangup is whether or not they can make the certification or the statement that they did not reduce the number of employees since they hired prior to the end of the covered period.
Yeah, that's an interesting question, because when you look at the certification, it makes it sound like, did the company reduce the number of employees? In this case, it was an involuntary reduction because the employee left, not the company terminated them. So you might say, based on that, I can still make the assertion that we did not reduce the number of employees. Obviously very subjective. Conversely, the guidance there also talks about certain things that you can ignore. Now they tell you you can ignore that if somebody left or you fired them and you were unable to rehire that position, and then you had documentation that you tried to do it, you can also ignore that reduction. However, it doesn't say that you can ignore the situation where you let somebody go and then were able to successfully hire somebody. So, that one, it is actually dealt with on the regular form 3508. And it won't count against you if you're able to replenish or refill that position, but it may actually kick you into having to fill out the full form rather than the EZ form. And, the fact that that's a relatively straightforward question involving one employee and one replacement, and that I can't give you a straight answer, just really talks to the fact that we need some more guidance on how these things are going to get applied from the SBA. It would seem to make sense, practically, that your head count's consistent. You are going to be able to meet the safe harbor on the full form. Why wouldn't you be able to use the EZ form? I would probably take that pathway initially with the bank and then talk to your banker about it as just an administrative convenience to try to do it that way, knowing that you might get pushed into the full form 3508 and still get the same positive answer, but you might have to do a little more reporting. So
yeah, but why not try to sidestep some of the work on the front end? I like your approach to that.
Yep.
All right, this next question is for you, Rick, and I like this one because it kind of nicely packages some of the conversations that we've been having over the past few weeks. So Scott asks, since it's been months since the covered expenses have been addressed again, any chance you could have a short recap of the time period of covered expenses, specifically accruals, basically how they're calculated, of payrolls and expenses that don't match with the covered period dates? So it's really a question, in my opinion, of the timing of certain items.
Yeah, that sounds great. And certainly this has a big impact when you get to what the actual dollar amount will be that goes into the application. So the basic rule is payroll costs that were paid during your covered period or alternative payroll covered period are includable. So taking a look at the question, I think it talks about if the payroll dates that it actually relates to are slightly misaligned with the covered period, can I still include that if the payment occurs during the covered period? And the answer would be yes. And in fact, that's one of the very few things that the SBA has been pretty clear on is even if the wages relate to before the covered period, if they're paid during, they've said yes, that those are includable. You also can include sort of a prorated portion on the back end of the covered period. So if you have wages that were incurred during the covered period but paid by the next regular payroll date after that, you can include the portion that were incurred during your covered period. So if you tally that all up, that oftentimes ends up leading to a greater number of weeks worth of pay would be included in your covered period.
Yeah, and Rick, that also would apply to non-payroll costs too, because we have that same convention of If it gets paid during that time, it's included, plus you can accrue what's on the back end. So in effect, you get a little benefit on the front end, pulling some costs from kind of a pre-loan period, and then you get everything through the end of your covered period. So, you know, you are going to get, let's say, 3 months of expenses potentially, or 8 weeks to 10 weeks of payroll, for instance, likely includable. So.
Well, what a great segue, Jack, with other expenses. Thanks for jumping in on that, because I've got another one for you. And that is related to self-paid rent. So we just got some guidance on that. And Elizabeth said that she's been having a hard time finding clarity on the self-paid rent and whether or not that is limited to just mortgage interest. So are you able to comment on that?
Yeah, you know, unfortunately, the guidance that came out on August 24th gave us some positive news and some negative news, right? And the negative news was definitely on the self-rental side. And we were concerned about this from the beginning, and it had been on one of those kind of issues that we were watching. Because if you think about it, if the building were owned in the same entity that got the loan, the only thing that would be deductible would be the interest that was paid on the mortgage for that building, right? The things like property taxes, insurance, other things that self-rental also covers, as well as the principal reduction, are not part of things that are includable in eligible cost for forgiveness. And ultimately, what you know, the guidance came out is that you have to look at it as if it were together, right? And so if it were together, the only thing that would be eligible for forgiveness is the interest on that debt. Now, where this really comes into play is if you've got a business, they're paying rent to a related party, and that related party has no debt on that building. Unfortunately, 100% of that self-rental will not be includable then. So that could have an impact. Now, the workaround to all of that obviously is the flexibility of the 24-week covered period. And hopefully, you know, even if self-rental is a big number for you, you can take an extra week or 2 weeks of payroll to augment your overall costs that are eligible and still get to 100% forgiveness without using the self-rental as an eligible cost.
Awesome. Well, I'd like to take the time to ask one final question, and this one is actually for Scott, and it relates to the deferral of payroll taxes. So the question is, if you have an employee who requests to have the deferral done, can it be done for just that employee, or do you have to do it for all of your employees?
Yeah, so first, I mean, the employer would need to decide if this is something they want to adopt and implement or not. And then, you know, from there, it does appear they would have the flexibility to allow employees to opt in or out of it. You know, we're seeing some varying things on that. You know, we're definitely seeing at the Fed Gov level, some of the Fed government agencies are telling employees that it's going to be mandatory that they can opt out of it. But you know, otherwise there does appear to be flexibility for, and in fact, we've seen some software programs are building this in at both the employer and the employee level, where you first the employer elects and checks the box that they want to implement, and then you can drill down to the employee level whether you want to implement or not. So at least that's what we're seeing right now based on current guidance.
Well, thankfully, it's been really straightforward, just like everything else has been with the CARES Act. Well, unfortunately, that is all the time we have for today. So I do want to thank all of our guests today. I want to thank all of our listeners for all of your questions, and all of our moderators who have been manning the live stream inbox for all of their support today and the great information and their answers. We would like to remind you to continue to visit our COVID-19 landing page at CLAConnect.com for more information on PPP forgiveness, as well as other hot topics. We do have a webinar series running on cash savings opportunities during COVID, and we have a lot of other fantastic resources that you can find on our website. So please continue to send us your questions, and we will be back with you next week with more information. Thank you so much for watching, and have a fantastic weekend. Thank you.
Thanks, Leslie.
Thanks.
Thanks.